The ceasefire that keeps collapsing. Hey, everybody, welcome back to another beautiful day in the real estate world. Today, we're going to go over what happened over the weekend with Iran and the United States, talk a little bit about Kevin Warsh, a little bit about the war in Iran, and a little bit about the bond yields and see where we're heading. Give us an explanation moving into the 4th of July week. So, without further ado, let's jump into the oil prices because these are the biggest movers right now and causing the most problems or non problems at this point. Last week we talked about how breaking below that $77 a barrel. By the way, this is Brent crude oil. I feel like I have to clarify that every time I touch on it. But anyway, we broke into that channel of $77 to $71 a barrel. We're starting to find a bit of a bottom after covering this major gap that we had back here at the end of February, right as the war started. We're almost back to pre-level wars or pre-war levels, excuse me. For oil on the Brent side of things. We're literally about $5 away, if that even. It's getting closer and closer. We might be starting to form a bit of a bottom. However, it doesn't look very strong, especially in the RSI, stochastic RSI. More than likely, we're going to actually see some more movement down. Moving into the week, it's crazy how they announced that there was a ceasefire breach on both sides of the spectrum this weekend, which was honestly, it doesn't really surprise me anymore. I'd say it's surprising. It's really not that surprising. WTI crude oil, we are still right above that. We're right above that range, that smaller channel at 67 to $65 a barrel, which is kind of that small point. Again, we're starting to find a bottom around 70. My guess is we're more than likely going to go a little bit lower again when we see the stochastic RSI having lower highs, lower highs, lower highs, and then a bottom, but not much volume. Same concept over here. RSI still hasn't broken out of that downward trend yet. So my guess is we're probably going to continue to stay right here for right now. The probability, more than likely, we're going to stay here and either moving down. Depending on how the war progresses, it sounds like they're going to be meeting a guitar this next week to kind of figure out what the next steps are for the ceasefire deal. They did sign an MOU, which is a memorandum of understanding. It wasn't an actual ceasefire deal, which was signed at the G7 summit here on the 17th of June. So we're barely a week and a half into this ceasefire deal. We're already seeing issues. It sounds like the majority of, well, let's just kind of break it down real quick. So June 17th, Trump and Iran president signed a memorandum of understanding at the Versailles. The formal framework to end the war started February 28th when U.S. and Israeli forces launched coordinated attacks on Iranian military and government sites. The deal was supposed to end hostiles on all fronts within 60 days. It lasted less than a week. On June 25th, the drone struck the Singapore flag cargo ship Ever Lovely in the Strait of Hormuz. The U.S. blamed Iran, and on the 26th, CENTCOM responded with a strikes on Iranian missile storage, drone facilities, and coastal radar sites. Its first offensive action on Iranian soil in roughly 2 weeks. So essentially, I got my kid behind me here, so I'm paying attention there a little bit. But essentially, we are not even 2 weeks into this peace deal or week into this peace deal, and we're already starting to see it fall apart at the cracks. However, it does. So far, the market hasn't reacted. The market opened 9 minutes ago, so it hasn't reacted to the point where it's going to be extremely negative. How? Because you'll notice these small hiccups come right on Friday, and then by Monday morning, they're kind of resolved. That's exactly where we're at right now. And then Trump, of course, went on social media this last weekend on Friday, and he says it's possible they may never learn. There may come a point where they're no longer able to be reasonable and will be forced to militarily complete the job. Basically saying that if Iran doesn't consider coming to the table and actually moving forward with things, we are going to see a full-on war and from the looks of it, trying to decimate an entire country. Iran fired back Sunday, targeting U.S. military interests in Kuwait and Bahrain with drones and missiles. No U.S. casualties were reported. By Monday, both sides agreed to stop attacks. See, by Friday afternoon, we're shooting shit. By Monday morning, when the market's open, we're all on good terms again. Meet in Doha, Qatar, for renewed talks. The latest pause in what analysts are calling a cat and mouse stalemate. What does this mean for our wallets? Apparently, this means for our wallets, what this does mean is it's costing us about $100 billion as the U.S. taxpayer, with gas prices running more than $1 above pre-war levels, which, don't get me started, but it took about 3 days for oil to go from $2.95 gas to go from about $2.97 here locally to over $4. And we've seen oil prices fall pretty significantly, again, almost to pre-war levels, and gas is still relatively the same place it has been. I mean, you're going to see things go up a lot quicker than you will see them go down, which is a little frustrating because, all of us over here, we're just trying to make ends meet. And when we see things, it's like as soon as companies have a reason to complain and say, hey, oh my God, things are going to go out of control, they raise prices immediately, but you never see prices come back down. It's just part of the world that we're living in currently. So it is what it is, but that's kind of where we're at on the Iranian front. Let's talk a little bit about Kevin Warsh and his first meeting last week. So Kevin Warsh had his first Fed meeting last week, and basically everybody was, I mean, I'm not surprised, but apparently everybody was anticipating that he was going to come in and just drop interest rates. And like, I get the mentality behind it. I think it's still plausible to see it done. I think we're more than likely going to see something like that happen here soon in the next year. I should say, as soon clarifying is the next year. But right now, inflation is double where it's supposed to be. The inflation they wanted to hit to start lowering interest rates was 2%. That was been the goal for the Fed for the past 2.5-3 years. And that core inflation hit about 4.1% in May. So meaning that we're about double where we need to be. However, with the war ending, there is a possibility that we're going to see I should say there's more confidence growing that we're going to see interest rates and everything kind of pull back. Like I've said before, though, it doesn't happen overnight. Like a war happens, war starts, and then companies react, right? You see defense companies react and see them spike. You see oil prices go up. You see mortgage rates go up, right? Like you see the world react so much quicker than when things start to teeter down and stop. And then it takes a couple of weeks for us to kind of level everything out. A couple months, sometimes even a couple of years, right? Depending on how bad the war really was. I mean, it was a bit of I don't know if you can call it a war, but a conflict, right? That did end lives, and it did create military issues. And now Iran is saying that we need $300 billion or something like that to rebuild our economy, blah, blah, blah. It's, I think we're farther away from rate cuts than we are from rate hikes. I mean, I'm not saying it's possible, but we'll just kind of read real quick. The Kevin Warsh chaired the first meeting this last week. It did not ease anybody's nerves, keeping policies at 3.5, 3.75% interest rates. No surprise there. But the summary of the economic projections stripped out the forward guidance market have been counting on. The 2 rate cuts wildly expected earlier this year gone. The new base case is hold and possibly hike. So right now, the Fed still isn't on board with cutting rates. Everybody kind of said, "Oh, he's going to be, the President Trump stooge, and he's going to cut rates immediately," and blah blah blah. He's a very bearish kind of guy or hawkish kind of person, I guess. As of right now, he's going to be more focused on raising interest rates to cut inflation so that he can bring more money into the economy. However, I still don't think that we're factoring the portion of growth, right? It did come in that on the jobs front here. On the jobs front, the picture is deteriorating. Factory jobs cut in June neared levels seen during the 2008 financial crisis and COVID. Manufacturing employment has declined in all but 3 states over the past 9 months, and the so-called K-shaped economy is widening. Business investment and AI sectors gains pulling one leg up, while working class consumers feel it's going the other direction. So AI and we just saw Ford actually hire back a bunch of engineers because they said that right now they fired a bunch of engineers because they felt that they didn't need engineers anymore with AI, right? But they're realizing that AI is not to the capacity that it was all hyped up to be yet. That's something that we should be talking about and be very aware of because it is not where it needs to be. Again, I'm going to refer AI to the tech bubble of 2000 of the internet. Like there is a lot of simplicities here that similarities, not simplicities, similarities here that could shift the way that our economy is going to be factored over the next 2 decades. However, in the immediate 6-month future, it is overvalued, it is overhyped, and it is not to the capacity that we are needing. We are still very short on the amount of data centers needed. We have tons of negative outpour communities, negative resilience from communities to put these data centers in place. And most of these data centers aren't even getting approved, or on the surface, right? The community doesn't approve of them, but they are getting placed. We have 2 in North Dakota alone that are talking about being placed in kind of some interesting places. I mean, we're actually 3 now. There's 1 almost completed south of Jamestown, and then there's 2 more here out by Center and out by Beulah. And I know most of you don't know where that is. Basically, small town, North Dakota. They're starting to build them closer to the refinery, not refinery, towards the towards the plants. And is it necessary? Sure. But the thing is like, as we continue to transition to a very data-driven cloud world, right, where the economy, you good back there, buddy? The economy is shifting and almost completely has shifted to full-on digital. To create that capacity is extremely hard, right? And we're not quite there yet either, right? So, I mean, there's ways that we're, you good back there? There's ways that we're going to be able to continue to grow this, but it's overhyped. And when 20% of the stocks in the S&P 500 are the reason that it is at all-time highs, it makes me very nervous, very concerned, because again, there's not really credibility behind it. Yes, it's useful. I mean, I'm using it right now to build out my weekly summaries now. I'm going to start using Claude to continue to build out my stuff because it can pull data a lot quicker than I can find it on Google. But it's not something where I can have run my entire YouTube channel. I still need to sit down and I need to strategize and come up with topics and do all these things. So like it's like the beginning of the internet, right? Like you had the ability to to talk with people all over the world. But what are you doing back there? But the world is now transitioned to where we use the internet for everything. But it took 2 decades to get there. I don't think it'll take that long with AI, but I still don't think that we're quite there. So when we talk about a bubble, the bubble isn't necessarily AI. It's the excitement of AI and the over anticipation of what it really has the capability to do yet. The silver lining behind this, though, is oil's pull back towards 75 bucks a barrel is disinflationary plank. Excuse me. If that holds, inflation may begin easing in the back half of 2026. Like I said, the more than likely, if we're going to see an easing in inflation, it's going to be the back end of the year towards midterms, because in order for midterms to continue to move in the right side's favor, they have to show the economy strong. And the only way to do that is by ending a war, starting to inflate more money into the economy, and potentially having rate cuts about 2 months. I'm guessing August, maybe September, at the very latest October. We're going to see some sort of interest rate drop. Something tells me that it's going to happen right before we see midterms. How soon before, I don't know, but we'll know more as the week kind of progresses. And just to kind of finalize, let's touch on bond yield just for a quick minute, and then we'll get you guys onto your Monday. Hope you have a great Monday. The 10-year Treasury dropped. Jesus Christ, this kid's throwing metal behind me. The 10-year Treasury closed a week at 4.39%, down 7 basis points from where it started, and briefly touched 4.4% for the first time in 7 weeks. This trigger was the May PCE inflation. So core inflation report came almost double what they were wanting it to be and over forecasted. But the zoom out to earlier in the week, and the picture was far more alarming, which was Kevin Warsh's meeting on Wednesday the 17th. Basically, about that's almost 2 weeks ago already. Jesus Christ, that's insane. But basically, what happened is that he came out hawkish in his first speech. Everybody was expecting a very dovish Fed chairman. Personally, I get where people were coming from. They were like, "Oh, President Trump's not going to put anybody in this hawkish, blah, blah, blah." But at the end of the day, I mean, we can all assume things, but relatively, his speech came out and people got nervous, right? Elevated term premium and steady Treasury issuance continued to support longer maturities, aligning with the long-term view that benchmark yields stay higher for longer. So that's basically what we're going to be expecting, higher yields for longer, right? We saw the 10-year Treasury come down a little bit, 2 years up pretty significantly, because I mean, let's just look at it from let's see, 2-year Treasury, right? And where is the 17th, right? May. All right, so 16th, right here, right, to the 17th. Look at that gap. That was a pretty big spike after the Fed meeting. Granted, about 5%. 5% in the bond yields is pretty insane, actually, in growth, right? So more than likely, we're going to see rates stay where they're at until we see some levelness, right? And that's common for really any time somebody gets into office, right? Because their policies still have to get used. The market still has to get used to the policies that they're going to be progressing with. And right now, the policy is hawkish. I mean, it was still hawkish when Jerome Powell was in the office, but at least there was some optimism for dovishness, right? Right now, it was a totally hawkish situation, and nobody's fully grasping that he's going to start cutting rates like everybody was anticipating. So, anyways, that's the update for Monday. I hope you have a great, like I said, I hope you have a great 4th of July week. We'll see you tomorrow, and thanks for watching. Make sure to like and follow, and we'll see you soon.